Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by BrightPath Notes. Now, here's your host, Justin Bogard.
Hello again, everyone. I'm Justin Bogard, and this is episode number 2 of the Be the Bank podcast, our newly rebranded podcast, formerly the Two Wealth Show. So today I got another guest, a friend of mine and a partner in business as well. And we're going to be discussing kind of REOs and NPLs. There's a lot of talk about those coming down the pike here in 2022. And we're going to be talking and debating and discussing around that subject matter. So without further ado, let's get right into this episode. Richard Thornton, you are my guest today. How are you, bud?
Sir, good, sir. How about you?
I'm doing very well. Thank you for asking.
Mm-hmm.
So the listener here doesn't really know a lot about you, Richard. I know a lot about you, and I could talk a while about you, but I kind of wanted to hear and want the listener to know kind of how you got into where you are today, really, in note investing.
Okay. Well, when I first started out, I really didn't know what I wanted to do, like a lot of us. But I got into syndications, primarily commercial stuff, and worked for a syndicator for a number of years, got a master's degree in finance, and that syndicator bought a bank. And so I became a lender, a commercial lender, and did that for a number of years until the S&L crisis came along.
SNL, do you mean Saturday Night Live?
That's right. That's right. I don't think so. And then after that, actually, we started my own mortgage banking company with another guy.
Okay.
And we did large apartment loans for the most part all over the country. Minimum loan size was $10 to $15 million. And sold that in the early 2000s. And then I syndicated assisted living facilities for the most part. I took a lot of my clients and said, hey, look, would you like to invest in X, Y, and Z? And we did that. And then a funny little thing called the recession came along.
Yeah.
And sort of put that to bed. But as part of that, I started doing hard money loans. I started a small hard money fund. I had about $4 or $5 million to manage of other people's money.
Okay.
And that evolved into investing in notes, and here I am today.
So where were you doing most of your hard money lending when you had that hard money
The
business?
hard money stuff was out here in California. We were just coming out of the recession. You could literally buy stuff for 30 cents on the dollar.
Oh, wow.
And make, at the beginning, you could probably make a good 50 to 70% profit on everything you did.
Holy cow.
So I did a number myself and did some for some other people. When too many newbies got into it and the margins started to thin, I said, it's time for me to bow out. And I did. And that's just when I started to focus on the notes and lending part.
You mean newbies as in newbie flippers or newbie lenders?
Newbie flippers. I mean, a lot of HGTV guys who got into it and said, oh, gee, I can make a fast buck on this. And they did. And a lot of them made a lot of money, but the margins started to drop. A lot of these guys were lucky if they made a 15% profit on it. And out here in California, at that point, you could buy something for $400,000 or $500,000, put $100,000 into it, and sell it for $8,000. Well, that's great, but you're probably only borrowing $300,000. You got to put $200,000 or $300,000 of your own money into it, and so if the market stalls, it stalls really hard. And so the risk from that standpoint was a little bit too great. I never really got into Midwest flipping. At this point, I'm kind of sorry I didn't, because there was a whole lot to do.
So what time frame was this? What years were you doing the hard money lending?
The hard money lending actually started in about probably 2010 and went to 2014, 2015. And then I started investing in notes after that.
So was it all over California, or was it specifically in a certain area of California?
All over California, yeah. I had a couple lenders I worked with, and I had my own funds and my own investors' funds. And
Mhm.
basically, we did residential stuff. And looking back at it, I could have done more commercial and kept on going. But I decided to actually focus on notes. But it was all over California. It was fun. I really enjoyed that. The market was very vibrant at the time. There was a lot of competition, but you could do very well as a private money lender. And I still actually am doing a little bit of that now because I think we're turning back towards where the market is. It's a good time to do that. So we have to all know how to pivot in this business. And I think it's time to start that again.
Sorry, Richard. I'm come down with something a little bit, so I have to cough every now and then. So I don't mean to intersect with my loud coughing.
You're fine.
So, okay. Well, let's bring it to fast forward to now note investing. So now you've learned the trade business of buying and selling loans and stuff, and that's kind of where you are today.
Right. Yes, I've probably got, I probably bought, I'd have to look at it, but 110 to 120 notes, something like that. Brokered a fair number of them, done a lot of what's called partials, as you know what a partial is, but the audience may not. It's where you actually purchase a portion of the note for a limited amount of time. If it's got a 25-year period left on it, I might sell an investor the first 10 years or something like that. So I've got a good number of partials out there, and have done some NPLs. Not by choice, but a
Right.
couple of my notes have gone that way. And then I've done some REO purchases also.
Okay. That is great, because that's a great lead into what we're going to get into today. So for the listener out there, we have what's called an REO and we have what's called an NPL. Now, an REO is a real estate owned piece of property, meaning a lender, someone like Richard or myself, has a property and we take back the property via a foreclosure. And now we have an REO. So that's a bank owned property. We might necessarily be a bank, but we're the lender, and that's just kind of how the naming convention came about. So an NPL is a non-performing loan, meaning a borrower hasn't made a payment in at least 91 days. And so that becomes in this category called non-performing. Now, the assumption is that that note is still going to continue to be non-performing. So there are options once you get into non-performing loans, and you can negotiate the terms with the borrower. You can forgive some debt or forbear some debt as well, and put it on the back of the loan. And if they simply can't afford to stay there, then you either can get a deed in lieu of foreclosure, where they just walk away from the property and they sign the property back over to you. Or lastly, you go through a true foreclosure in that state, and you go through the judicial process, and then you get the property back via foreclosure. And in Indiana, we call it a sheriff's sale. And so those are kind of the definitions of an REO and an NPL. So Richard, you have mentioned that you have purchased REOs. You've mentioned that you've gotten NPLs, and you've gotten NPLs from the fact that they were performing and then they were not performing. So
Right.
you have experienced both worlds. I myself have done similar things. I've bought the REOs, and I've also had NPLs that I bought intentionally, and I've also had performing loans go non-performing as well. So we both have some experience there. So today's conversation, I want to figure out, today's market is a little bit different than what it was in that 08-09 fiasco, where the real estate appreciation dropped dramatically and people were underwater with their mortgages pretty much overnight. And so today's economy, where real estate is appreciating so much in value, the folks that can't afford to make their payment, they're actually sitting okay as far as equity in the property. They got this ghost equity that just appeared, or this phantom equity in their property, to where they can just refinance out. They can get out of the situation pretty good. Some folks, however, choose to do the forbearance route, and then they get stuck in this deal, and they can't afford to make this payment. So we got a different type of NPL today. Now, Richard, I know you keep up on some data just as well as I do, and there were some non-performing loans that didn't go through foreclosure before COVID started, right?
Yes, I mean there was a market. We were at a low rate. I think I look at the Mortgage Bankers Association, the
Hmm.
MBA standards, and I think we were right at 2.6 to 3% in terms of a foreclosure rate nationally pre-COVID.
Hmm.
That's an all-time low, and we are above that now. But as you know, with all the restrictions on foreclosure, a lot of that has not happened. We're in a very interesting market, as you mentioned, in that with the recession before, rates were up and values were down.
Hmm.
So it was a hard crash for a lot of people. There was no way to get out. What we're seeing in the market right now is rates are down and values are up. So where we thought there was going to be a huge wave of foreclosures, a number of people are actually saying, "Gosh, I've still got a job, or am reemployed, so they can qualify for a conventional mortgage. They've got more equity in their house, so what they're actually able to do is refinance, pay off their payments that they forbeared or forebode. I don't know. I think it's
Well,
forbeared.
I don't know what the
Um,
proper grammar is either. That's
yeah,
a weird word.
right. Um, anyway, didn't pay and basically work their way out of it. So they are able to sort of do a self restructure. So
Okay.
thus far, we're not seeing the huge wave that we thought we were going to see. That being said, there's still going to be a lot of product out there. I think we're going to see a lot of REO and a lot of foreclosures.
Which do you think you're going to see more of here in 2022, REOs or NPLs?
Good question. I think that will be specific to certain areas.
Okay.
So the higher cost areas,
Like California,
like
right?
California,
Okay.
where I am right now, especially the Bay Area, I would think there that you would see more REOs because uh, if people can refinance, they will refinance. And frankly, there's just a lot of money out in here in this
Okay.
market, especially this market being all of California. Uh, the crypto money and the tech money has saved a lot of people's bacon. I mean, you're seeing a lot of people who lost their jobs, who had good stock portfolios, who can sell the stock, who can restructure, and so I think overall volume will be down. But when I say down, I mean compared to what it was in '08.
Right.
But if you're going to crash, I think you're going to crash hard. You're not going to crash into an NPL. That's just, I guess, that's just the way it feels. Whereas in some markets where you don't have that tech money and maybe crypto money rolling around, there you're going to see just maybe more NPLs that'll eventually become REOs.
Okay. As you were talking there, I was seeing what side of the fence I was on, and I hadn't considered what you said about certain geographical areas if they were more REOs or NPLs. And you're right. I do agree with you that California would be a great example of the average house in California has got to be over like $1 million, it seems like, right? Because of some of the very high end cities.
Yeah, the Bay Area here, I think the median price is 1.2 or 1.3.
Yeah.
That's median,
Yeah. Median.
right?
You can look that up on Google if you're not sure what the difference between median and average.
Right.
Won't get into discussion on that today. So my thought is there's going to be more NPLs and REOs, and I do think it's region specific, but I think it's going to be more NPLs across the country than there are going to be REOs, and I believe that the banks are just not going to want to go through the process of going through the foreclosure. I think they saw the light at the end of the tunnel back in '08, '09 when it was just easier just to sell off the NPL. And it seems like the Fannie and the Freddie, Fannie Mae and Freddie Mac, excuse me, they are selling off some of their inventory that's delinquent. Now, there was a bottleneck before COVID started, Richard. I asked you that question on purpose, and I don't know if
Mhm.
you had a chance to answer it, but there were NPLs that were getting ready to go through foreclosure or getting ready to be traded or sold
Right.
before COVID happened. And then when COVID happened, kind of everything shut down in general, and it
Right.
stalled that process. Now, those loans, Richard, they could have been easily a couple of years delinquent before COVID even happened. So just imagine in January of 2020, you had loans that were getting ready to go through the delinquent mitigation process within that bank, and they were already 2 years behind in payments. Now, COVID happens. You add another 18 months to that. Oh, let's not forget the forbearance federal mandate that happened as well. That caused those loans to be kind of forced into forbearance if the borrower wanted to. And so now you have at least 4 years of delinquencies on some of those loans. Now, granted, some of them could have been, back in 2016 when they stopped paying, what have you. Let's just make a conservative approach here. So now you have these loans that are going to be at least 4 to, let's say, 6 years delinquent. Now that's interesting.
Yeah, I hate to say it, but I've got personal experience there. I had that exact situation on a deal in Birmingham, Alabama,
Okay.
that I just sold as REO, and they hadn't paid for 18 months. We slipped into COVID. I couldn't foreclose,
Yeah.
and they decided to do me the favor of trashing the house before they left, and I sold it as REO.
Okay. Well, sometimes this stuff isn't pretty, but
No.
usually at the end of the day, we come out looking okay.
Yeah, I mean, on that one, I actually lost very little by the time I sold
Okay.
it. This is where the uptick in the market helped. I
Yeah.
think I lost a couple $1,000s, so it was not
Okay.
a big deal.
Yeah.
And out of all the notes I've had, I've only ever had 3 defaults, 2 of which I never lost any money, and that one is the one I lost. So overall, my portfolio has done, I think, extremely well.
Yeah, those are really good numbers, especially
Yeah.
if you've gotten over 100, bought and sold over 100 loans as well.
Yeah.
That's pretty good default rate on your portfolio. So that
Yeah.
just goes to show that seller financing is a very viable option for investing as well. And that's what Richard and I both invest in. This is for the listener here.
Right.
Okay, so all that mess is let's say it's in the ether somewhere, and it's getting ready to happen. It's going. A lot of states are opening up. A lot of counties are opening up for the judicial process to take effect. And by the way, just for the listener, there's a non-judicial process and there's a judicial process in states. Some states require the judicial process of foreclosure, and some states don't require it. The difference is the non-judicial, it's just a lot faster. So just remember that non-judicial equals a lot faster process for foreclosure.
Right. Right.
So now we've got, and I don't know what the numbers are because I haven't read into the exact numbers, but I'm sure it's in the millions of loans that are delinquent that are just sitting there ready to be taken action on, whether they're going to be foreclosed by the lending institution or whether they're going to be traded off to a hedge fund who's going to trade them off to another hedge fund, and we know how the waterfall effect works there. So I don't think I've seen any information that tells me, Richard, are all the counties going through allowing foreclosure right now? Is it some of the counties? Is it all the counties? I don't really know. It seems like to me, the counties that I've been researching and running into just in my portfolio, they're allowing foreclosures to happen. Have you seen the same thing?
Yeah, I mean, every place I'm invested, there's allowing it. I know that there's some counties in Washington State, or the state itself they keep extending the foreclosures and things like that. I think it's spotty across the country.
Yeah.
So you'd have to look at your local real estate broker or something like that and say, find out what's going on before you could really answer that question.
So, Richard, my thought on this non-performing loans coming through here is it's going to be a slow trickle of non-performing loans. I don't think the floodgates are going to open and it's going to be everything going to be coming through the county at one time. It seems like it's going to be a slow trickle might be a bad word. I think it's going to be like a drip. I don't think it's going to be like a big gush because quite honestly, I haven't really seen it yet.
Yeah, I would agree with that, especially because values are up. When we came out of the recession, values were down. The banks were looking at properties in a lot of cases that were underwater. And so they knew that if they sold it, they wanted to sell it quickly. because they knew they weren't going to get anything out of it, and to hold on to it just increased the pain. Now, though, they've got, in a lot of cases, increased values. So they can afford to hold on to it, or they will want to hold on to it a little bit longer. Now, there's a whole lot of technicalities with banks in terms
Right.
of their lending ratios and their reserve requirements. And so they don't want to hold on to too many, because it affects their reserve requirements and then affects the amount of money that they can lend. And we don't need to get into all that.
Right.
But the fact is that values are up. So they're going to want to piecemeal those out a little more slowly so that they can get their full dollar out of their mortgages.
Okay. All right, Richard, we got REOs, we got NPLs. We've discussed what they are. We've discussed kind of what happens before COVID and what we think is going to happen after COVID. Obviously, we don't have a crystal ball. So what do you like better going forward? Do you like the REO purchase, or do you like the NPL purchase?
Well, I think everybody has to answer that question individually.
Okay.
And you have to look at a number of factors. One, you have to look at your own background. Have you been a lender? Do you know anything about lending?
Mm-hmm.
Would you be teaching yourself what to do if you bought an NPL? I mean, a lot of people jump in this and really don't know a whole lot about loan terms and what
Right.
the possibilities are in restructuring.
Mm-hmm.
So if you don't know a lot of that, it can be kind of painful to learn it. So what you might want to do is jump into REO, as opposed to, if you have a little bit of lending experience or feel like you know about that, you might want to do NPLs. There's pluses and minuses to both. And do you want to discuss that now, or what would you like to do?
What do you want to do? Do you want to get into REO, or do you want to get into NPL going forward?
Well, personally, I want to get into NPLs. The reason being, you have more, I think, flexibility. Now, REO is going to be a little bit cheaper than an NPL is, because you have more certainty. Everything we try and do is risk and reward, right? If you buy an REO, you don't have to do anything with the judicial process and the foreclosure process. It's a clean slate. You may have structural problems. Quite often, if you bid on something at auction, or even if you just buy it from a bank and it's already REO, you don't, especially if it's out of state, you can't inspect it. It may have flaws that you can't see. Inspectors don't always find everything. I bought a property in Illinois that was REO once. And the inspector neglected to tell me that all the HVAC stuff had been moved out. The piping was stripped out of it.
Oh, nice.
And it had no water heater. Just
Nice.
little things like that.
Little things, yeah.
Yeah, that you think an inspector would get. But, this guy was busy and basically didn't want to go inside. So, but that being said, if you buy REO, you have fewer moving parts. Whereas if you buy an NPL, you can guesstimate that the house is going to be in better condition because it's occupied. Somebody's living in it, right? And you have the flexibility of working with that person. So you can restructure, you can ask them to, you can evict or whatever else, but it can be an easier path for you having to do less renovation and things like that. So those are the pluses of NPLs. You're probably going to have to pay more for them than REO.
Okay. Why do you think that is? You explained that a little bit earlier, but I want to kind of dive into that.
Well, you're going to have to pay for more because you have, how do I want to say this? You have more flexibility. In other words, as I mentioned before, you have a property that's probably occupied. If it's occupied, it's probably in a decent condition, as opposed to something that has been trashed and or may have serious flaws in it. You have the possibility to talk with XYZ borrower and say, hey, look, can we restructure? Can we do whatever? And basically, in 30 to 60 days, you've got an operable loan that's working just fine. Whereas with an REO, you don't have that flexibility.
Richard, thanks for explaining all that. Those are some great details in explaining your thought process on the NPL today, why you would or wouldn't do it, and the plus and minuses of REOs and NPLs. I don't see how the NPL would be more expensive than the REO. I've listened to what you said, and I don't see that. I think the NPL will be cheaper. I personally, moving forward, will be looking more towards NPLs for the similar reasons for what Richard said, because me being a note investor, I'm knowledgeable and experienced in the process of NPL, so it doesn't scare me. I know what to do. If I was on the other side of the fence and I wasn't a note investor or didn't have experience, I would definitely lean towards the REO because it's easier, right? It's less moving parts, like you said, which was a great point. But I think the NPL will still be cheaper than the REO. And I guess my reasons for saying that is that for it to become an REO, it was an NPL before that. And if it was an NPL and if I was buying it, I would have the intention, because especially in today's market, that if I bought it and it didn't work out to where the borrower couldn't renegotiate the terms with what we offered, when they didn't want to do if they want to do a deed in lieu or go through the foreclosure, I would think that it's going to be much more valuable to me as an REO, and I'll be able to make more money on it because I can take it back with the appreciation that's going on, especially with these really good neighborhoods when these borrowers are there. I feel like I would make more money. So I think the REO would be a little bit more expensive than buying the NPL.
Yeah, those are all really good points. And something else I didn't mention
Mhm.
is where do you want to invest? Do you want to invest in
Yeah.
your backyard or out of state?
Yeah.
If you've got some renovation experience and you're not afraid of that process, and there are good deals in your backyard, if I were to do deals here, buy REO here
In California.
in
Yeah.
California, if as long as I'm more towards the coast, it's a pretty big ticket. In other words,
Okay.
I'm probably going to have to roll in there with $500,000, put
Right.
in 100,000 or so, and I can make good money, but um, I have to have a big bankroll. If I moved more into Southern California, not Southern
Mhm.
California, I'm sorry, Central California, I could probably buy a house for maybe 300,000 and put 50 or 70,000 into it. So it's a lot less expensive. But that for me is a 2-hour drive.
Right.
So if you're living like you are in the Midwest or something like that, you can look in your area and find REOs that you can inspect. You can, you don't care if an inspector, you can look at
Right.
it and say, oh, geez, this,
Right.
is missing X, Y, or Z or needs this, and get a good feel for it. Then you very well may want to do REOs all day long because it's an easier execution from that standpoint.
No, that's a good point and a great explanation, because I would feel more comfortable having a non-performing loan from a distance across the country than I would in REO,
Right.
for the reasons that you mentioned. I think having boots on the ground, or you personally touching the asset or looking at the asset as an REO, I feel a lot more comfortable doing that than I would um, doing that from a distance. I definitely feel more comfortable doing an NPL from a distance. So I guess that's another reason why I would do the NPL, to go back and answer that question. So yeah, great points, Richard.
Yeah. And so one other thing we should mention too is if you're going to do something from a distance, um, and when I say not performing notes, I mean NPLs or REO,
Hmm.
you probably should focus on an area. So focus on Des Moines or focus on Indianapolis or whatever. Choose your criteria based on economics or whatever else you think is relevant.
Hmm.
But get a team. Um, uh, so know that you've got a contractor or two in your back pocket.
Right.
Know that you've got somebody that's good for title and things like that. Because otherwise, if you're scattered all over, you're trying to find somebody new. And frankly, you're going to get fleeced. I mean, I can't tell you the first couple of distant renovations I tried to do. I got extremely inflated numbers for the property clean out and
Yep.
things like that. And they were legitimate. They were doing their job because they had to contact somebody locally and blah, blah, blah.
Hmm.
But if I'd had somebody in my back pocket that wanted to do repeat work,
Right.
my costs would have been half of what they were.
Yeah, that's something you definitely have to be careful of. Richard, I want to switch gears here for a second, and I want to talk about us being note investors. And for the listener here that is interested in getting into note investing, Do you have any like go-to material as far as a book or information or an individual that puts out, information that you go to kind of get some good sourcing information to learn about note investing?
Yeah, thanks for asking the question. I actually do on my website, amnotecap.com. It's www.amnotecap.com. I've got a booklet that says, so you can invest in mortgage notes.
Okay.
I've got another book that I've actually written that gives you all the basic information. It's focused on performing notes,
Mhm.
but it lays out all the basics so that you get to know all the terms and things like that. So I also have a American Note Capital, that's the name of my company, YouTube channel. And I've got, I think, 21 videos on there now, and you can learn a lot from those. One of them is it's a series of 9, me just sitting at my desk talking about investing in notes, what to look for and things like that. It's nothing fancy, but it's most people find it very informative.
Awesome. Well, thanks, Richard, for sharing that. That's kind of all the time we got here for today's episode. Richard, thanks for coming on episode number 2 of our newly rebranded Be the Bank podcast, formerly the Two Wealth Show. And thanks for always being my friend and an ear to listen to when I got issues or problems and talk through it. I really appreciate it, Richard.
Yeah, I appreciate the friendship and the collegiality also. So it's a good partnership.
All right, Richard, thanks again so much for being on episode number 2. And for the listener, we will see you next time.
Great. Thanks very much. Bye-bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our BrightPath Notes channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by BrightPath Notes. Thanks again for listening.